Welcome back to the Deep Dive. Today, we're really getting into the mindset of a legendary value investor, right at a critical point. Just before things got really chaotic financially, we're focusing entirely on the Fairfax Financial Holdings Limited 2006 shareholders letter. And, it opens with this really powerful statement.
It really does. It sets the scene immediately. It says, their biblical 7 lean years are over. I mean,
Yeah.
that's quite a claim. This wasn't just your standard financial report. It felt like a moment of maybe vindication for Prem Watsa and Fairfax. 2006 was supposed to be the year they finally cleaned up all those legacy issues that had kind of dragged them down for, well, half a decade.
Exactly. And our mission here today is really to cut through the corporate speak and the dense numbers. We want to give you the strategic DNA of this pivotal year. We want you to walk away really understanding the operational success, the record results, the big balance sheet cleanup, and maybe even more importantly, that deeply defensive stance they took just as global markets were, well, peaking.
Yeah, and you really have to hold two kind of competing ideas in your head for 2006. On one side, the company itself internally was doing great. The subsidiaries were performing exceptionally well. But on the other hand, the bottom line took a huge hit, a massive $413 million non-cash charge after tax. And that was all tied to this big housekeeping move, the Swiss Re commutation.
Right. So the cleanup cost a fortune, accounting-wise, but the actual core business was firing on all cylinders. And when you look at the long-term compounding, I mean, the story is just staggering. Their book value, $150.16 per basic share, was up 9.2% just in 2006. But stretch that back to 85 when they started. Their book value is roughly 100 times what they began with. That's 24% annual compound growth over 21 years. That kind of performance, that longevity, it's incredibly rare.
It really is. It's the hallmark of genuine patient investing, isn't it?
Yeah.
Where the underlying strength just keeps compounding, even when the headlines are all about, temporary, painful operational stuff. Being able to compound at 24% for 2 decades, it means management was just executing flawlessly on their core discipline.
Okay, let's unpack that operational discipline then, because that seems to be the real heart of the letter. If you kind of look past that $413 million charge, the cleanup cost, what were the subsidiaries actually doing?
They were hitting records. Crum & Forster and Odyssey both had record profits in 2006, and that came from like a perfect mix of disciplined underwriting and smart investment income. This wasn't luck. This was the payoff from years of, frankly, painful internal restructuring.
And looking at their compound growth rates, just for the 5 years ending in 2006, these are big numbers, especially considering the time period. Northbridge at 21.3%, Crum & Forster 17.5%, Odyssey 18.7%.
And here's where the context is so important. It's easy to see a number like, say, 18% and think, oh, nice job. But you got to remember, 2004 and 2005 were just brutal years for property and casualty insurers. We're talking about huge hurricane losses, Katrina, Rita, Wilma. Those losses alone added 14 points to their combined ratio back in 2005.
Okay, hold on. Let's pause there for the listener. When you say combined ratio, what exactly is that? And why is a 14-point hit so significant?
Good question. Yeah, the combined ratio is basically the insurance company's operational report card. Simple version. It's losses plus expenses divided by the premiums they brought in. If the ratio is 100%, you're breaking even just on the insurance side. Anything under 100% means you're actually making a profit from writing policies, even before you count investment income.
Got it. So when those hurricane losses cost them 14 points, it means their ratio jumped way over 100%. They were losing money just selling insurance that year.
Exactly right. So to pull off that kind of compound growth, despite those massive losses, and while still dealing with ongoing reserve issues, well, it tells you the underlying discipline was really strong, just waiting for its chance to shine.
That leads perfectly into a big point in the letter. The years of frustration around those acquisitions of Crum & Forster and TIG back in 98, 99. Shareholders were getting understandably edgy about how long the turnarounds were taking.
Yeah, and Watsa addressed that directly with a classic analogy. He basically said, it's too early to judge because they were only at the end of the 3rd inning in a 9-inning ballgame. He admitted it was a very trying period, took longer than anyone thought it would, but the result, he argued, was worth it. You ended up with these newly disciplined, highly focused underwriting companies.
And the proof seems to be right there in the consolidated numbers. Underwriting income hit a record $198.2 million in 2006, a level they'd never reached before. And that pushed the consolidated combined ratio down to 95.5%.
That 95.5%, that's just pure operational victory. It means they're making money on underwriting alone, generating free cash flow, which they can then invest. It really confirms that those 7 lean years, cleaning up bad deals and old underwriting mistakes, were finally truly over.
Okay, let's shift gears now to segment two. This is all about the big financial housekeeping moves they made to kind of de-risk the company, maybe prepare for uncertainty. The biggest one, the one that caused that huge non-cash charge, was the Swiss Re commutation. What does that actually mean in plain English?
Right, commutation. Think of it like dissolving a partnership early or canceling a really long-term contract for a fixed cash payment now. Fairfax had this very complex, long-running reinsurance agreement with Swiss Re called a corporate cover. They wrapped it up in August 2006 and got about $585 million in cash out of it.
So they took a big non-cash hit, that $413 million charge we keep mentioning, just to get the cash and kill this agreement.
Pretty much, yeah. They accepted the accounting pain, which is mostly just an adjustment on paper, to get immediate cash and get rid of a long-term complication. And crucially, this meant their European runoff businesses, those old books of bad insurance policies, just slowly paying out claims. They probably wouldn't need any cash injections from Fairfax through 2007. Plus, they eliminated something like $45 million in annual interest and fees tied to that old agreement. So it's a trade-off. Short-term accounting pain for long-term cash flow improvement and less risk.
Sounds like a necessary move, but definitely a painful one on the books. And speaking of painful, the letter talks about the embarrassing restatement. The way they handled that seems quite telling, doesn't it?
It really is. They just owned it. Called them honest mistakes, mostly accounting errors from 2001 and before. And it knocked $235.3 million off shareholders' equity. But the key point they hammered home was that it had zero impact on cash flows or the fundamental strength of the business. They were upfront, found the issues themselves, and promised to fix the controls. That says a lot about corporate integrity, I think.
Integrity, yeah, but also really aggressive de-risking. They spent 2006 just relentlessly strengthening the balance sheet, holding company debt cut by over $210 million, eliminated a $122.5 million note from TIG, saving $9 million a year in interest.
And don't forget the Odyssey move. They lowered their stake from 80% down to 60%. That brought in another $338 million in net cash. End result. They finished 2006 holding a record $767.4 million in cash and short-term investments at the holding company level. That's a huge war chest, clearly intended, to buffer them against the financial storm they seemed to feel was brewing.
And all this de-risking happened right as they shifted their long-term financial goal. Why did they change that objective?
That was purely down to Canadian GAAP, the accounting rules. The rules change, basically forcing them to use mark-to-market accounting for their stock holdings, which means the value of their stock portfolio now bounces around on their balance sheet every day, whether they sell anything or not.
So they had to adapt their target to match the accounting reality.
Exactly. The new goal became a 15% per year compound growth in mark-to-market book value per share over the long haul. It signals they're still committed to compounding value, but now that value has to be reflected in real time on the balance sheet. It kind of forces even more discipline around their equity choices.
Okay, moving into segment three. We see that underwriting discipline getting tested almost immediately by shifting market cycles. They just hit that great 95.5% combined ratio, but the overall insurance environment was already starting to soften.
It absolutely was. They noted the hard market, which had lasted longer because of 9/11 claims, and then the hurricanes was definitely on the downswing. Prices were starting to drop across the industry. It was becoming common.
So what was Fairfax's instruction to their teams in that kind of softening market?
Classic value approach.
Huh.
If the price isn't right, you step back. The clear message was, let premiums shrink rather than write business at prices that are just too low. They fully expected their total premiums would likely drop in 2007 precisely because they refused to chase volume if it meant sacrificing profit margins. That takes serious guts when your competitors are maybe cutting prices to keep business.
Which makes those Asian success stories they highlighted even more interesting. It shows where they were willing to grow and where that discipline was paying off internationally.
It's exactly right. Take Seneca, for instance, part of Crum & Forster. They bought it in 2000 for $65 million. Since then, its book value grew 16% a year, and it maintained an incredible average combined ratio of 86.8%. Just spectacular performance. They gave credit to the local management team, led by Doug Libby.
And First Capital in Singapore, that combined ratio is just wow.
Stunning, isn't it? Over the 5 years ending in 2006, their average combined ratio was 72.5%. I mean, they were basically printing money on the underwriting side. and their book value doubled to nearly $70 million. It just shows the power of focused, super disciplined underwriting in the right places.
And then there's ICICI Lombard in India, a joint venture that became the biggest private general insurer there, 12.5% market share. How did they manage that kind of growth while staying disciplined?
That's maybe the most fascinating one.
Yeah.
They were in huge expansion mode, building 220 offices, hiring 5,000 people. Normally, when you expense that kind of massive build-out, your combined ratio gets destroyed, at least initially. But somehow, they managed an average combined ratio of 96% during that period. They were balancing explosive growth with really solid underwriting right from day one.
Okay, that sets things up perfectly for segment 4, because now we pivot to the investment side and the team's deep, almost alarming caution, such a stark contrast to the operational success they were just celebrating.
The contrast really couldn't be sharper. While the operations guys were, maybe taking a victory lap after the turnaround, the investment managers, Hamble and Watsa, were deeply, deeply worried about the outside world.
Yeah.
Now, their long-term record was fantastic, 15-year stock returns of 17.2% a year versus the S&P 500 at 10.6%. But in 2006, their focus was almost entirely on defense.
And the letter gets really specific about their concerns, right? Especially the U.S. economy, the housing market.
Yeah.
They call it the bubble reversing, focusing on subprime.
They didn't mince words at all. They said the reversal has just begun and has a long way to go.
Yeah.
It was a fundamental critique of the, reckless lending that was happening. They even threw in that anecdote about the mortgage originator getting paid more to do no income verification loans.
Mm-hmm.
I mean, that little snippet just perfectly captures the absurdity and the systemic risk they saw building.
And beyond housing, they raised another interesting flag: deflation. Back in 2006, most people were worried about inflation. But Fairfax was arguing that the huge rise in global production, China, India, Russia, Latin America, meant that maybe deflationary pressures were the bigger long-term issue to watch.
Yeah, it speaks to their contrarian thinking, doesn't it? They look at the big structural shifts, not just, temporary price blips. If global capacity keeps pushing prices down long term, then their strategy needed to guard against a deflationary debt spiral. That's a very different beast than simple inflation.
But the strongest warning, the part that really seems prophetic now, was aimed right at structured finance. They called out the insane issuance of collateralized bonds, mortgages, loans, and the letter explicitly says Fairfax held none of it. Zero.
They saw the core flaw in the whole thing, this assumption that structure will eliminate or significantly reduce all risks. They pointed out the absurdity. You had thousands of AAA-rated collateralized bond issues flooding the market, but fewer than 10 actual U.S. corporations rated AAA. They knew the risk wasn't gone. It was just being sliced, diced, hidden, and spread around in ways nobody fully understood.
They even quoted Grant's interest rate observer, saying the debt pileup was causing the financial edifice to sway even in a dead calm. This wasn't just a vague worry. It was a detailed condemnation of what they saw as a ticking time bomb.
Exactly, and that's the context for why they were maintaining those incredibly expensive hedges. Their S&P 500 hedges cost them $159 million in 2006 alone. Their credit default swaps lost $87 million. That year, they were down 74% cumulatively since they bought them. This is a massive drag on reported earnings.
That is a huge amount of money to spend on bets that were, at that point, losing badly. How did they justify sticking with such expensive insurance when it was costing them so much?
The justification is pure defensive value investing philosophy. They argued those hedges weren't meant for just a normal down year. They were protection against the 1 in 50 or 1 in 100 year financial market disaster. The cost of that protection, they believed, was necessary because it allowed them to comfortably hold $2.3 billion in stocks, knowing that if that catastrophe actually hit, the hedges would preserve their capital. It was a survival strategy, plain and simple, not about maximizing profit every single quarter.
Wow, that really puts 2006 into sharp perspective, doesn't it? A year where they pulled off this amazing internal turnaround, but felt they had to buy the most expensive possible insurance against an external crisis that, frankly, very few others seem to see coming with such clarity.
That duality is really the lasting takeaway from this letter, I think. You have internal operational success, this feeling of we finally fixed it, coupled with this intense, almost paranoid external defensive posture. They also formalized their leadership team then, too, bringing in Brad Martin as COO, Greg Taylor as CFO. It felt like they were setting up the team for whatever came next.
And one last thing, a brief but really fascinating point they included: the lawsuit. They mentioned filing suit against certain hedge funds and others back in July 2006, alleging market manipulation and intimidation.
Yeah, it's a powerful little detail. They noted it was only the second lawsuit they'd ever filed in 21 years, but they made it crystal clear they wouldn't tolerate that kind of behavior.
Yeah.
They pointed out they'd won their first suit, which was about similar stuff, illegal market manipulation in London. So they're basically telling shareholders, look, we're willing to fight legally to protect our long-term value from people trying to game the system.
Okay, so let's leave our listeners with this final provocative thought to chew on. When a company like Fairfax Conservative, highly disciplined, focused on decades-long value creation, finds it necessary to spend significant time and money filing major lawsuits against alleged market manipulation just to defend its capital, what does that tell you about the modern challenges of simply protecting value investing principles from, well, market malpractice?
It really raises the question, doesn't it? Has actively defending market integrity become like a necessary cost of doing business for truly patient investors? Is discipline on its own still enough when you might be facing systemic bad faith?
A really stunning deep dive into a year that was both a triumph and in many ways a prophecy. We'll see you next time.